Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Aldana Hayek, a cross-asset reporter with Bloomberg.
And this week on the show, well, as you've probably heard by now, for the last 2 weeks, trouble in the U.S. and European banking sectors, not to mention the responses to it from authorities, has captivated the attention of investors. And it's sparking fears of a credit crunch that could ultimately drag the economy into a recession. It doesn't yet appear to be as big of a train wreck as the global financial crisis in 2008. Knock on wood, fingers crossed, and all that. Still, it's hard not to get flashbacks to that troubling era. So we're going to do a little comparing and contrasting to that ugly time with a veteran market strategist who was helping to manage a $3.4 billion market-making book back then. But first, Vildana, I did hear from a loyal listener because you left us with a little bit of a cliffhanger last week, and he was worried about you. You had told us you were just about to close on a mortgage with First Republic
First
Bank.
Republic. Yeah.
So how'd it go? Tell what was the resolution?
You have no idea how stressed I was. Like a nutcase last week. I was so worried about First Republic.
Just last week?
More so than usual, like way more so than usual. And I like when something's really weighing on me, I can't help but bring it up all the time. So I would run. I ran into the radio producer.
I've noticed.
Yes, but even like the radio producer, Paul Brennan, we took the escalator up at the Bloomberg office. He was like, "How are you?" And I was like, "I'm not well. First Republic is my bank." He was like, "Oh, okay."
Well, it's stressful enough to close on a new home in normal times, so I can't even imagine.
Yeah.
But how'd it go?
Oh, so we closed. We rushed it and we closed on Friday. Rushing is not a good thing, obviously, but in this case, I think it's okay to make an exception.
Oh, yeah.
It's closed. It's done. It's good as of Friday night.
Good.
Yeah. But, even our guest on the podcast this week, I told, because I couldn't help myself but to to tell him about all my troubles when I was talking to him last week. And I told him, I was like, "Oh, I have this mortgage pending with First Republic." And all he said back was, "Oh." And then we never spoke again, which was not a good sign of confidence.
I thought you were going to be looking for a couch to crash on.
Oh my gosh, stop it. Oh my gosh, no. But maybe our guest can explain why he just left me hanging like that when I was looking for reassurances. I want to bring in Steve Sosnick, chief strategist at Interactive Brokers. Thanks so much for joining us.
It's great to be here, Vildana. Great to be here, Mike. If just in my own defense, I figured if I had nothing constructive to say, and I could sort of sense the nervousness, even via the IB messages, I figured it was best not to say anything. But fortunately, it worked out because I really had no idea what would happen. God forbid.
I think nobody knows. And you did the opposite of what Mike did. Mike would find really bad stories and then copy paste the worst parts of people panicking. And he would send them to me highlighted with the worst parts. And he'd be like, "I'm sure you already saw this, but just FYI.
You better start double apping, which is a new word I learned. People with pending mortgages at First Republic were applying for other mortgages, double apping, they call it.
Yeah.
And I was like, Vildana, why aren't you double apping? But they came through. Hey,
yeah.
Shout
out to my banker, Kyle.
One thing I was going to say was already too late because once you'd already closed was once they got the lifeline, you figure you got a 3-4 month window because they're not going any. Well, I figure they're not going anywhere for a while. They're not going immediately out. And but with not knowing how far along you were in the process, I just if I don't have anything helpful to say, it's best not to say anything.
And I would also assume if you're getting a mortgage at I know you got a pretty good rate, but at any rate that's sort of a prevailing market rate or close to it, they're going to want to close on that regardless if the building's on fire, I would think, at this point. So there's that. Okay,
so Steve, the reason I was talking to you last week and some of my teammates is because we've been asking people, where were you in 2008 and what were some of the lessons learned that you can apply to today? And obviously we're getting a ton of comparisons to that period of time. I think Jonathan Farrow from Bloomberg TV said something, well, just to put it a bit more in perspective, because maybe it's sort of like panicky to make comparisons to 2008 at this point. So he said something like, it's like saying, oh, I broke my foot. It really hurts, but it's all right. It's not as bad as like that time I got shot, So like, is it warranted at this point to be making those comparisons? And maybe you can tell us about some of those lessons learned from 2008 that you're applying to today.
It's not unwarranted. The problem is we're always looking for a historical precedent, and it behooves us to think about what paradigm, because we all need to think in terms of some sort of paradigm. What paradigm is most like what we're seeing? Well, the last bank crisis, that we know, that really took hold was in 2008. We're not there yet. We're not at that full-fledged, and I hope we don't get there. Let me be very clear. We're not at the point where things have really begun to metastasize. And I do think because we've set up some firewalls systemically, Dodd-Frank and some of the exotic products that caused the last crisis are not really as prevalent. We're not, subprime mortgages are not a thing this time. I assume you went through all kinds of nice credit checks to get your mortgage, Vildana. They weren't just handing them out. Banks this time around have not been using credit default swaps to substitute for permanent capital, that sort of thing. So it is different. There's a lot. So far, the banks that have come out under crisis, it's a little more straightforward. I mean, with Silvergate, and the culprit there is crypto as part of sort of the ongoing crypto troubles, which, you can speak to better than I can. But then you had SVB, which, we all know the story there. It's a classic mismatch. It's really, they had too many deposits that they couldn't actually loan out in sort of an efficient way, but they kept taking them in anyway. And so that was sort of a plain vanilla type of a problem, really duration risk, which always is a risk for banks. Along the way, you had Signature Bank, which, was not only a little bit of crypto and a little bit of, they seem to have their finger in every sort of oddball place in the banking system, taxi loans, et cetera, et cetera. And then, of course, Credit Suisse, which has been, choose my words carefully, they've been under some stress for quite some time. Let me put it that way. And so
that's a nice way to put it.
So in that sense, we're not at the level where we started to worry about banks like Citigroup and Deutsche Bank and things like that. Although I guess Credit Suisse is analogous to Deutsche Bank and UBS, which ironically had its own issues back then and is now the acquirer. So there's definitely, history. They say history doesn't repeat, but it often rhymes. And I think there's a certain rhyme to it, but we're not there yet. And I certainly hope we don't get there. But so, I mean, I was at that point, my responsibility was making markets and being a specialist in bank options. And so that was it was a very challenging time. I do think I will say we did rather well then. I know that's really counterintuitive, and especially when systemic risk is afoot. But the thing that really got us on the right foot was almost a random conversation I had.
Yeah, tell us about this, because we talked about this, and I want to give credit to Katie Greifeld, who originally asked you this question, and you told this great story. So if you wouldn't mind telling our audience about it.
We're in a small office building in Greenwich, and you park in the garage underneath because that's, everybody commutes by car because it's Connecticut, and so get in the elevator, and there's Thomas Peterffy, who founded the firm, and whom I'm sure the listeners are familiar with. Get in the elevator. What's new? And Thomas is not a man who's big on small talk, so it's that was, I think, more, I took that as a business related question rather than tell him about the kids and stuff. And I said, what's really interesting to me is the story that I'm reading this morning about how Bear Stearns may have as much as 20 billion in losses at some of their hedge funds. And he said, 20 billion? I said, no, that's the number that's being thrown around. I obviously don't know if it's 100% true, but I trust the reporting. And he said, how big is, what's their market cap? And I said, I think about 20 billion. Now, at this point, it's only like a 4-story building, so we're out of the elevator at this point, walking down the hall. And I said, I think it's about 20 billion-ish. And he looks at me and said, are you telling me Bear Stearns is broke? And I said, I wasn't going to put it that way, but now that this is why Thomas is, this is why Thomas is the success he is. He's, because he sees right through these situations. I said, I guess I am, aren't I? And he looked at me and he said, don't sell any puts on banks until you hear from me otherwise. And that was
wow.
That was probably, I don't think I heard from him otherwise for about a year and a half. But which is not to say I never sold a put. It's impractical. You can't do that as a market maker. But what it means is don't be a net seller of puts. If you sell them, replace them. Adjust the models so that we are not the best offer on them. And one of the interesting features that came out in 2008 was because credit default swaps were pretty new. And really, I believe that every new financial innovation gets a real world test, and some of them pass and some of them fail and some of them get rejiggered as a result of it. And that was credit default swaps real world test. And they were being used in inappropriate ways, and the market wasn't ready for a full scale test of credit default, of how they work. But the logical hedge, if you're trading credit default swaps, is to buy long-term out-of-the-money puts on equities. And so the big trade there was people buying whatever the lowest strike leap put was on insert bank name here. Because that would be, if I had sold credit default swaps on Lehman Brothers, because of the way a capital structure works, the bonds go bad before stocks. And I know that's an issue here with Credit Suisse and the cocoa bonds, et cetera. We'll get it, I'm not a restructuring expert. My brother actually is. I haven't gotten a straight answer at it. I haven't asked him actually how that all is working out. But what happens is, what happened there is, so if the bonds are going to go bad, well, then the stock is going to go bad. The stock's going to go worse. So people were really clamoring for those. So it just basically kept ratcheting up that volatility, and kept ratcheting it up. But as a result, we went into this and stayed into it pretty much on a decent footing. Which is not to say there weren't hiccups and accidents and everything else. As a market maker, you sort of expect that you're going to have your bad days and your bad weeks and even your bad months, but you keep tight risk parameters, and over time, if you're doing it right, it pays off. You collect a lot of change along the way, and sometimes you make pennies and give back dollars, but you have to manage the dollars that you give back. And we fortunately were able to not give back the dollars. And in those days, we always pretty much ran a long volatility model. Just that was the way we traded. It could be expensive. A lot of people don't do that. But in an era where volatility was constantly rising, more or less, and skew was getting extraordinarily steep, it worked for us, and we were in a good place at the right time.
Something to be said for taking the elevator ride with the boss, I guess. This is a good argument for everyone getting back into the office, I guess. I say as I'm working from home today, but big picture wise too, I'm thinking about the difference in the reaction function from the government and the central banks to this occasion versus 2008. I'm thinking back to that original vote. I think it was in the House on the Tarp Bill. There was a lot of optimism in the market that, of course, they're going to pass this bill, the Tarp Bill, to inject capital into all the biggest banks. And it failed on the first vote, and the market just, went down instantly in a big way. I forget the exact numbers, but this response to me seems much quicker, much more focused and targeted, and sort of able to put out the fire a lot quicker. Is that your impression too?
Absolutely, yes.
Yeah.
Once they were writing the playbook in 2008. And I think to a certain extent, they've been using that playbook, particularly in 2020, and they're using it now. And that was essentially monetary and fiscal shock and awe. And I think, in 2008, remember there was they ridiculed Helicopter Ben, but that actually, he wasn't wrong, and the Nobel Committee eventually agreed. But that was, real world test of one of his theories, which was essentially drop money out of helicopters in the time of a crisis. And I think now they've realized, well, it works. And that was, that was why it had worked during COVID, and there really wasn't much complaint about what the Fed was doing, and there was certainly, the fiscal bills were generally passed along bipartisan lines. So there wasn't. So by now, we sort of we're going to use that playbook, which I think is a good thing. That's kind of that means we're actually learning from our efforts, societally. Now we can argue to what extent it's appropriate. We can certainly question whether there was moral hazard in the way they guaranteed all deposits, sort of with the stroke of a pen, at Silicon Valley Bank, and who benefited from that. I mean, we're going to be arguing about this for a while, and of course, we're still, with the Fed meeting yesterday, we're still dealing with the idea of, did the Fed and Congress, the fiscal authorities, overdo it in their response to COVID? I mean, that'll be the stuff, when Vildana's my age, she'll be having that discussion. She'll be having that discussion with the
in a couple of years, right?
You got a ways to go till you catch up to me. But that's really
she'll still be talking about her mortgage, I think, Steve. She'll still be telling that war story.
Yeah.
Well, that's mortgage. Well,
it added 20 years to my life just from stress.
Yeah, Steve, one thing, there's almost this knee-jerk reaction in the market, I think, to this notion of the Fed's balance sheet. A bunch of banks went to the discount window at the Fed and borrowed, I don't know what the exact number is at the moment, but call it hundreds of billions of dollars. The thinking in many quarters is that, well, that's almost like quantitative easing, or at least a reversal of the quantitative tightening that the central bank was doing. I'm not sure if that's the appropriate way to look at it. The Fed increasing its balance sheet by extending discount window loans versus buying treasuries and mortgage securities. Is that the wrong way to think about that, do you think?
It's interesting because I've had this exact debate with my colleague, Jose Torres, who's an economist. And he pointed out after the last H.4.1 report, which is something I actually, in a nerdy way, look at every Thursday afternoon. But you're probably not old enough to remember, on Thursday afternoons, everybody stopped to wait for the M2 report when I started out in the business. That was the thing everybody was looking forward to. So, so we've had this debate, and he said, well, look, the deposits went up by about, I think it was 300 billion or something, which would eradicate essentially the QT that's done year to date. Meanwhile, though, they did continue to let securities roll off the balance sheet. So I think that the differentiating factor here is the deposit stuff is meant to be a Band-Aid, whereas the QT is meant to be more of a permanent shift in the way the Fed is approaching that, tightening and easing of their balance sheet. But they used their balance sheet in a crisis. And so I don't think it's apples to apples, but certainly they did throw money into the system. They need to do it to keep lubricating the gears. I just think it's a little bit, in theory, this 300 billion can roll itself off. I don't think it has yet. We'll know this afternoon, I guess. But I think as long as there's stress in the banking system, it's going to, the Fed is and can be the guarantor of, the lender of last resort. And it's, to me, this is one of the fascinating things, right? We've talked about we haven't yet, but the Fed's dual mandate is stable prices and full employment. Yet it's very clear that the Fed's real job, and why they were created, was to maintain the safety and stability of the banking system. Now, without a safety and stability of the banking system, you can't have stable prices and full employment. But their real mandate is sort of unspoken. And I think but it's important that that mandate really comes into play when there's a crisis going on. And that's what we're seeing now.
Steve, I'm curious, because everything keeps changing so much, so fast, how your thinking has evolved since the start of the year. And obviously, we even had some economists at some of the big banks coming out before this week's Fed meeting saying they're not going to be hiking rates. And obviously, they raised by 25 basis points. So how are you thinking about all of the changes, everything we've seen, everything we've heard from the Fed, the bank turmoil, everything, and how it's your thinking about what we might be seeing for the remainder of the year has evolved?
My thinking really hasn't changed all that much. I'm still of the belief that we're in a period where if the Fed is raising rates and if the Fed is shrinking their balance sheet, things are going to break and you're going to have accidents. Well, we did. And I think that the problem here is that I'm going to take a little victory lap, because literally what I wrote yesterday was that, let me just pull it up, was that my base case was for a 25 basis point hike. The Fed doesn't typically surprise market. No hike would be considered a surprise. If they stood pat, people would worry about what's wrong. But you now have the dot plot. I won't go into the whole thing, but basically then said the dot plot was going to be relatively unchanged, which was very much at odds with Fed funds futures, and that he would play down concerns about the banking crisis metastasizing, which would actually potentially disappoint people. I think that all fits, and I think that's still what we see now. We saw sort of the way that zero-dated options can cause microbursts of volatility. That's a new feature. It's not as dire as I think a lot of other people believe it is. I really don't think it's systemic. I just think it's, buckle up and get used to it. But I still think this is the issue. And right now, what I'm wrestling with are two basic things. One thing I didn't really foresee was that the January effect would be quite so lasting. I think we're still seeing the January effect. I think the risk-on move that we're seeing occurred largely because some of your biggest, most followed, most popular stocks, both within individuals and institutions, got the crap kicked out of them in 2022. And that led to a lot of tax loss selling in December, which then made it even worse. They got deeply oversold. They were the first to bounce, as well they should have. And I think that bounce then turned into a full-fledged risk-on rally, which I didn't actually foresee the amount, the legs that this would have. And I think that's what we're wrestling with now. And I think that, we're still seeing it. We're also getting, though, tremendous concentration. Apple and Microsoft are together, just those two stocks are about 13% of S&P right now, and about 25% of the QQQs.
That's nuts.
I think back, you want a bigger historical precedent. Certainly I wasn't active then, but I've read up on it. Was the Nifty 50 or the one decision stocks back in the 60s. And those, eventually, every time you've had narrowing leadership, it tends to work out somewhat poorly and end in a bad way. And I'm not going quite so far, but if we're that top heavy in two stocks, that's not a great sign. But another thesis of mine that I've really been laying out recently is that I think it's generational. And I think, we can debate that with different generations here on this podcast. I think if you were not around in 2008, if you were around in 2008, you're wary, because you've been through this before. And as we said, it's not the same. It's not as bad yet, but it's too early to give the all clear. It could get worse before it gets better. My theory, which I've grossed out two of your colleagues, but I'm going to say it again anyway, is, if you see one cockroach, there's probably plenty more hiding just out of sight. And so right. I think the older crowd, those who've been through a crisis like this, have that in the back of their mind. And I was out to dinner with some friends of mine a week ago, and that was sort of the theory. What else is lurking out there? if you're younger, you've only really ever lived through a period where the Fed has been your friend and where there's been no inflation. That's the part of my main thesis that I think is still has to be worked out, is that the Fed is at every given turn, they're telling you that they're fighting inflation first. And Powell told us that yesterday. And yet there's a certain amount of disbelief, and there's certainly a big amount of disbelief in the Fed funds futures, which I think that'll merit its own part of the conversation. But generationally, you look at anything that might look as the Fed coming into the market as Fed easing. This is good, and like you said, Mike, it's tough to say it's exactly the same thing. The Fed's not necessarily easing for the best reasons, and it's not clear they're really easing, especially if they're raising rates at the same time. Any investor who's sort of under 40 has never been in a period where the Fed has not been a tailwind, with the exception of like a few months here and there. And that's so I think you're getting two very different mindsets at work. Not a bad thing, but it'll have to get resolved. We find out if it gets in favor of the younger set or the older set. And the problem also is none of us, unless you're sort of in your 70s or older, have been investing in a period where inflation was problematic.
Right.
And so no one knows what that playbook is like firsthand. I could talk about what the playbook was like firsthand in 2008. I can't talk about what the playbook was like in 1978, 1979.
And the historical data is not as complete for back then. It's hard to, even as if you're a quant, to go back and parse it and pick it apart the way you do with modern data. One note to listeners, we are recording this episode on Thursday, March 23rd. So keep that in mind when any references to yesterday and today. In case, I don't know, Valdana, maybe some people are listening to this on Saturday night. They're having a party and this is their soundtrack.
I listen to podcasts on Saturday night.
I'm sure you do. But Steve, I always love to sort of cut to the chase here and get to just tell me what to do with my money right now. What are you advising? What's the best way to position right now in the markets? I mean, you've got money market funds that are finally sporting a yield that's 3 or 4%. Is it cash? Is it you excited about long duration bonds? Is it defensive stocks? What would you be doing right now?
I've tended toward risk averse, which has meant that I missed, a lot of the NASDAQ move higher. I don't feel like I've missed too much in terms of the S&P, the S&P and the broader stuff. Let's go back and think of what the theses have been for investing over the last few years. Number one, don't fight the Fed. So what does that mean right now? Does that mean loading up on risk? No, because the Fed is not your friend at this point. And whatever market-friendly things they may be doing now, it's crisis response, not true stimulus. There is no alternative. Yes, there is. Now there is.
Right.
I think we're in the situation we're in is because for so long there was no alternative. And so money, liquidity, like financial liquidity, is like real liquids. It finds the lowest level. And we're still working through a lot of liquidity that found the lowest level during 2020, 2021, et cetera. The economy is generally robust. I think we can argue whether we're going to come in for a soft landing, a hard landing. My gut tells me this probably doesn't end all that well, but the question, of course, is when, and the question is how much. Now, I think it's great that on the job front, things are going along swimmingly. It's also not so terrible, by the way, if you have a job, to see the fact that wages are strong. So it is that. Let me preface it that way. But I think the problem you have now is you've got a lot of, you really have this dissonant factor going on. You've got stock markets happy because they see the idea that rates might come down. But you have to ask yourself, why are they going to come down? the Fed, as we mentioned in the dot plot, the Fed governors who have been saying all along, we don't see any rate hikes through the end of the year, pretty much said the same thing yesterday. The dot plot's telling us, rate cuts rather, we're not cutting rates by the end of the year. Yet, at one point at the end of the day, late in the day, it's bounced back a little bit. The Fed funds futures for the January 24 meeting were showing 3.99.
Yeah.
So that's a lot of cuts. So ask yourself, what do we have to do to get those cuts?
More cockroaches.
Well, that's kind of my worry, is nothing good. Unless we magically beat inflation, in which case I still don't think the Fed is going to be racing to cut rates. If you've just won the war, you're not going to start a new one, which is what rate cutting would do if you just sort of arbitrarily said, let me just say it this way, pause does not mean pivot, right. Under normal circumstances. So otherwise, what we would need to be is you'd either have to have some sort of financial accident or some sort of recession, neither of which is particularly market friendly. So that to me is a huge cognitive dissonance out there in terms of what's being priced in certain places, what's being priced in order to justify, the rallies we're having. If stocks are supposed to be looking 6 to 12 months down the road, what are you looking at? And that's the tricky part right now.
Steve Sosnick, chief strategist at Interactive Brokers. All right, Steve, well, we can't let you go just yet. As a veteran of the show, we've got to hear about the craziest thing you saw in markets. Valdana, I have a funny feeling we're all going to pick the same crazy thing. So I'm going to scoop us all and go first. How about that?
Yes.
We often talk about these futures contracts in the market, oil, soybeans, corn, whatever it is. You don't often think about what it means to take delivery of those contracts. And at the London Metal Exchange, they had a little bit of an issue on that front. They announced they had canceled 9 nickel contracts worth about $1.3 million after discovering, quote unquote, irregularities. Now, you know what the irregularities were? When they went and looked at these bags of nickel, it was just a bunch of bags of rocks. And,
I knew you were going to go with this story, which is why I...
it's one of my favorite stories ever. And JP Morgan turned out to be the owner of, I think, at least some of these nickel contracts. Whenever there's a crazy nickel story in the market, you can count on JP Morgan and the LME being at the center of it. So I don't think they've figured out why there were bags of rocks instead of bags of nickel. But I'm dying to know. I wonder if that had something to do with that short squeeze.
I would love to know who found it. Like, who found the bags of rocks?
Yeah,
I don't know. There's so much more we need to know about this story.
Absolutely. I mean, the idea. Well, first of all, just think of all the craziness. When nickel prices were going insane, it would behoove some scammy person to say, what if I just delivered a bet? What if I just, what if I sell short and sell them and I got nothing to deliver? So, maybe no one will catch me, and no one did.
Someone had to sneak into this warehouse, remove I don't know, or maybe it came from the supplier. Who knows? We'll have to stay tuned and see how this all resolves itself. Hopefully they figure out what happened, but I don't know. One of my favorites.
That's a good one.
So what do you got?
I knew you were going to go with it. Okay, mine is not markets related.
Okay.
This is seriously, I'll happily be a loser of this game this week because it has absolutely nothing to do with anything. It's just, it's my favorite story of the week. It's a 90-year-old tortoise named Mr. Pickles. He's the new dad of 3. So he has 3 brand new tortoise babies, and they're named Dill, Gherkin, and Jalapeno.
Dill, Gherkin, and at age 98?
Houston Zoo. He's 90 years old, and his wife is 53, I think. Wife is a generous term. I just really like this story, and they're so small and extremely cute, and they can fit like in the palm of your hand. They're so tiny.
All right. Well, that's pretty good.
You can't. Nobody can see. I'm looking at pictures.
I'm sure there's a market for, I don't know, turtle meat. So maybe that's how.
Stop it. Oh my God. They're an endangered species.
And one of the reasons the Galapagos turtles are endangered is because there was a market for it. Because if you were sailing along and stuck in the middle of the Pacific, they would Galapagos in Spanish means tortoise, and they would land on the Galapagos Islands, put a couple tortoises on the boat. They didn't need much care and feeding, and you could feed your crew for months. That actually is it's just,
See where you brought the conversation, Mike?
I know we were talking about nice little turtles, and I shouldn't have gone there. Sorry.
No.
This is how you become a chief strategist, by the way. If you you need a meal on a boat near the Galapagos, Steve's got you covered.
Not anymore. They're endangered. I wouldn't do that.
How about you, Steve? What's the craziest thing you saw?
I came with two because I figured one of you might beat me to the bag of rock story. So mine is that perhaps the best investment in markets right now is swag in defunct banks. As someone I know who still has a Solomon Brothers rugby shirt, and I think I have from my summer intern days an LF Rothschild umbrella still. I know from my defunct securities firm Swag. And apparently, if you had, apparently there was some sort of Credit Suisse hat that was very popular. That's going for good money, and they're not even defunct. But SVB stuff, and so I think the eBayers are having some fun with the swag, and so I think that's financial markets related enough. No,
that's pretty good. Yeah, no, yeah. And in fact, I think that's been a contender in the past. So it's always good to revisit that market. I once found an MF Global golf ball out on the course, and I meant to throw that up on eBay, but I think I lost it.
I have a countrywide that I found, and I keep it in my golf bag just as a reminder of what can go wrong on the golf course too.
It's a good metaphor.
The takeaway at the end of all of of this segment always is that it's good and it pays off to be a hoarder.
That's right. That's right. That's right. I'm hoping one day my wife will listen and realize why I hoard so much stuff around here. But hey, take that free hat when you're at the conference, Vildana. You never know. I
should go through my crypto swag.
Yeah. Don't throw it out. I
throw everything out.
Steve Sosnick of Interactive Brokers. Always a pleasure to catch up with you, Steve. Thanks so much.
My pleasure, Mike. My pleasure, Vildana. Thank you so much for inviting me today. I can't believe how fast the time went. I hope it went as fast for the listeners as it did for me sitting here.
We'll catch you next time. What Goes Up will be back next week. Until then, you can find us on the Bloomberg terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show on Apple Podcasts so more listeners can find us. And you can find us on Twitter. Follow me at Reganonymous. Vildana Heinrich is at Vildana Heinrich. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong. Thanks for listening. See you next time.